Okay, we're going to conclude our Chapter 3 discussion by looking at how to prepare what's called the schedules of cost of goods manufactured and the cost of goods sold. So pretty much we're taking the information we've learned earlier and now put into more of a schedule format. When you think about your product cost, again, you have three components: direct materials, direct labor, and you have your manufacturing overhead. So the actual schedule we'll take a look at now, it will look at the cost of all the raw materials and direct labor that was used in production, and the amount of overhead that was applied during production to that job. And we'll look at the total manufacturing costs associated with the goods that were finished during that particular period. So if you think back to job A we just did in the previous video lecture, we're looking at all of the raw material used to produce job A, the direct labor cost to produce job A, as well as the overhead costs that we're going to assign to job A. Okay? So let's take a look at the product cost flow part, but from a schedule standpoint. Think about your raw material. You have your beginning raw materials, which is what you have remaining from the previous accounting period. We add to that raw material that we purchased during the course of the accounting period. When you add those together, it tells you the amount of raw material that was available to be used in production. Okay? We'll then subtract out what's remaining in raw material from what was available, and the difference will tell us the amount of material that was used in production. So think about our particular example with the raw materials we had before. If we begin with 5,000, but then you purchase, say, 60,000, that would give 65,000 worth of material. But if you only have 20,000 remaining, that means 45,000 was used in production. That cost goes to your direct material cost, which is part of your manufacturing cost. Okay. Next to that, we're going to add the direct labor costs that incurred during the course of the accounting period. Then we're going to determine the amount of overhead that's going to be applied to this particular job based upon the predetermined overhead rate and the actual allocation of the overhead basis, such as direct labor or machine hours. So when you add your direct material costs, direct labor costs, along with your overhead that's been applied, that gives us our total manufacturing cost. Okay? From there, we look at our work in process account. You have beginning work in process. That's the cost remaining from the previous accounting period. You then add in your total manufacturing costs for the current accounting period. When you add those together, it gives you total work in process for the period. Okay? From there, sorry about that. From there, we'll subtract out the ending work in process. We're saying, how much do we have in work in process at the end of the accounting period? If you subtract what's remaining from the total that was in the account, the difference gives you your cost of goods manufactured. That will show the total cost that was transferred from work in process during the course of the accounting period over to your finished goods inventory account. So from a schedule perspective, the cost of goods manufactured is transferred from work in process over to finished goods. So for finished goods, you take your beginning finished goods inventory. That's what was in the account at the beginning of the accounting period. You add your cost of goods manufactured. That shows what you produced and finished during the current accounting period. And when you add those two together, that equals your cost of goods available for sale. That shows the amount of inventory we had available to be sold to our customers during the course of the accounting period. You'll then subtract your ending finished goods inventory. That's showing what you have remaining, and the difference is your cost of goods sold. Remember before that we had 1,000 gold medallions, but we sold 750 of those gold medallions. So the cost of those 250 is what you have. That would be your finished goods inventory remaining balance, but the cost of the 750 sold represents what's known as your cost of goods sold. And remember that cost of goods sold, that is an expense that's going to be shown on your income statement. So let's try a few examples to make sure we understand the cost flow system and how to calculate these different costs. Beginning raw material was $32,000. During the year, we purchased raw material for $276,000. Account at the end revealed $28,000 of raw material was still present. What is the cost of the direct material that was used? So to solve this problem, we're going to take our beginning inventory, add in the amount purchased, meaning the amount available was a total of $308,000. At the end, we have $20,000 worth of material that is still remaining. Therefore, the amount used for the period, raw material used, is $280,000. That amount will be transferred from raw materials over to your work in process inventory account. Next, direct material used in production total $280. Direct labor was $375, and $180,000 of manufacturing overhead was added to production for the month, meaning that was the amount of the applied overhead. What were total manufacturing costs incurred for the month? So you're going to add your direct materials plus your direct labor along with the manufacturing overhead applied. When you add those all together, the total manufacturing cost that incurred for the month would equal $835,000. Next, beginning work in process was $125,000. Manufacturing cost for the month was $835,000. There were $20,000 of partially finished goods remaining in work in process at the end of the month. What was the cost of goods manufactured during the month? Okay, so we start off with our beginning work in process. We're going to add the cost incurred for the period, and they'll total $960. Subtract out the cost remaining at the end of the period to $200,000. Therefore, the cost of goods manufactured total $760,000. So we're showing how we're going to calculate these different figures for work in process, cost of goods manufactured, finished goods inventory, utilizing a cost of goods manufactured schedule. Want another one? Okay. Beginning finished goods was $130,000. The cost of goods manufactured total $760. Go back. And it says, I'm sorry. Hold on. I'll do it again. Start over. Rewind. Beginning finished goods inventory was $130,000. The cost of goods manufactured for the month total $760. And the ending finished goods inventory was $150,000. It said, what was the cost of goods sold for the month? Okay. So you got to ask yourself, how do you approach this problem? You take your finished goods beginning amount, the 130, add the 760, which is your cost of goods manufactured for the month. That gives you 890. Subtract out the ending finished goods inventory. So that gives us a cost of goods sold of $740,000. This shows the cost of those items that were sold to our customers during the course of the accounting period. Okay, last topic. We talked about the overhead that's going to be assigned compared to the actual overhead that was applied. So depending upon when you're applying overhead, overhead could be underapplied or it could be overapplied. We'll take a look at how do you account for overapplied or underapplied overhead. When you have underapplied overhead, it simply means that the overhead applied to a job was less than the actual overhead for the year. And if you have over-applied overhead, it means that the overhead applied to a job was greater than the actual overhead that took place during the course of the accounting period. So we'll take a look at how do you account for overhead that's over-applied or overhead that may have been under-applied. We have the parent company that had actual overhead for the year of $650,000, okay, with a total of 170,000 direct labor hours worked on this job. They're going to assign overhead based upon a predetermined overhead rate of $4 per direct labor hour, okay? So we're going to assign overhead based upon the allocation base, which is direct labor hours. So you will multiply the 170,000 direct labor hours times $4. So the applied overhead would be $680,000. The actual overhead was $650,000. So in this case, the actual overhead is less than the applied. Therefore, we have over-applied overhead in the amount of $30,000. We've applied more overhead than what actually took place during the course of the accounting period. The question is, what will we do with this over-applied overhead? Well, we have two different options. We can close it out to the cost of goods sold account, or it can be closed proportionally to work in process, finished goods, and cost of goods sold. We're going to look at option number one. All right. So in this situation, we're going to apply the over-applied overhead to the cost of goods sold account. What it means is that cost of goods sold was overstated. We applied more cost to this job than what we should have. So to make the adjustment in this situation, we're going to record it on the left-hand side of the overhead count. So now that this account zeroes out, and we're going to record it on the right-hand side of the cost of goods sold account to decrease that amount. Because before adjustment, this account was overstated because we applied more overhead to the account than what actually took place. In the case of under-applied overhead, it would be a reversal. You would increase the cost of goods sold account on the left-hand side and record it on the right-hand side of the manufacturing overhead count. Okay? Woo, that was a lot. That will conclude our discussion on Chapter 3. Be sure to watch all 4 of the video lectures and the other resources assigned for Chapter 3. Bye-bye.